Ladies and gentlemen, it is 3:47 in the morning. I have not slept. I will not sleep. Because what I discovered 6 hours ago has fundamentally changed my understanding of where the global financial system is heading. At 3 a.m. Eastern Time, while most of America was asleep, while the financial news networks were running reruns, while nobody was watching, the Federal Reserve Board of Governors published a final ruling on their website. No press conference, no announcement, no mainstream media coverage, just a quiet PDF upload to federalreserve.gov in the middle of the night. I have spent the last 6 hours reading this document, cross-referencing it with Bank for International Settlements guidelines, comparing it to European Central Bank implementation timelines. And what I found is going to shock you. Because this ruling, this quiet middle-of-the-night regulatory change, completes something that started in 2019. Something that the banking establishment has been preparing for. Something that fundamentally changes how gold is treated in the global banking system. And it goes into effect Monday morning. Not next month, not next quarter. Monday. The countdown has started. And most people have absolutely no idea what is coming. Let me start from the beginning. Because if you do not understand the history, if you do not understand the regulatory framework, if you do not understand what Basel III actually is, you will not grasp the magnitude of what is happening. In 2008, the global financial system nearly collapsed. Lehman Brothers failed. Bear Stearns failed. AIG required a government bailout. Banks around the world were over-leveraged. They had taken on too much risk. They did not have enough capital to absorb losses. The Bank for International Settlements, the BIS, headquartered in Basel, Switzerland, responded by creating new global banking standards. These standards are called Basel III, and they govern how every major bank in the world must operate. Basel III establishes capital requirements. It defines what counts as high-quality capital. It determines how risky different assets are, and it forces banks to hold more capital against risky assets. Here is the key concept you need to understand. Tier 1 capital. Tier 1 capital is the highest quality capital a bank can hold. It includes cash. It includes government bonds from stable countries. It includes shareholder equity. Tier 1 capital is what protects depositors if a bank takes losses. It is the foundation of banking stability. Under the original Basel III framework implemented in 2013, gold was not considered Tier 1 capital. Physical gold was classified as a Tier 3 asset. It received a 50% risk weighting. That means if a bank held $100 million of gold, regulators only counted it as $50 million of capital. This made gold capital inefficient. Banks had no incentive to hold it. Every dollar in gold was only worth 50 cents for regulatory purposes, so banks avoided gold. They preferred cash and government bonds. But that changed. On June 28, 2021, the European Union implemented something called the Net Stable Funding Ratio, the NSFR. This was the next phase of Basel III. And buried within the NSFR requirements was a provision that nobody in the mainstream financial media discussed. Physical allocated gold was reclassified. Under the new NSFR rules, physical gold that is allocated, meaning gold bars stored in a vault with clear ownership assigned to the bank, received a 0% required stable funding rate. Let me explain what that means. Under the old rules, if a bank held unallocated gold, meaning paper gold, gold IOUs, claims on gold that might not physically exist, the bank needed to hold stable funding equal to 85% of that position. But physical allocated gold? 0%. This completely changed the economics. Suddenly, physical gold was capital efficient. Suddenly, physical gold strengthened bank balance sheets. Suddenly, there was a massive regulatory incentive to hold real metal instead of paper claims. The UK implemented the same rules on January 1, 2022. Switzerland implemented them. Japan implemented them. And the United States delayed. For 3 years, the Federal Reserve has been working on what they call Basel III Endgame. This is the final implementation of Basel III standards in the American banking system. The original proposal was published in July 2023. It was supposed to be implemented by July 2025, but the banking lobby pushed back. They claimed the rules were too strict. They claimed implementation would hurt lending. They demanded changes. So the Federal Reserve delayed, and delayed again. But here's what the financial media is not telling you. While the headline provisions were being debated, while the banks were lobbying against stricter capital requirements, the gold provisions were quietly finalized. The ruling published at 3 a.m. this morning confirms it. Effective Monday, American banks will receive the same treatment for physical allocated gold that European banks have had since 2021. Physical gold held in allocated form will be treated as a zero-risk asset for NSFR purposes. This means the largest banks in America, J.P. Morgan, Bank of America, Citigroup, Goldman Sachs, they now have the same regulatory incentive to hold physical gold that European banks have had for 3 years, and they are behind. Let me show you the data. Because what I'm about to reveal explains everything that has been happening in the gold market over the past 3 years. Since June 2021, when European NSFR rules took effect, central banks around the world have been buying gold at a record pace. In 2022, central banks purchased 1,082 metric tons of gold. That was the highest annual total since 1967. Since 1967, that is 55 years. In 2023, central banks purchased 1,037 metric tons, the second highest year on record. In 2024, the pace accelerated. First quarter purchases hit 290 metric tons. That is on track for over 100 metric tons for the full year. Do you understand what is happening? Central banks are not speculating on gold prices. Central banks do not day trade. They are accumulating gold because the regulatory framework now favors it. The People's Bank of China has added gold to its reserves for 18 consecutive months. Poland's central bank doubled its gold holdings. Singapore, India, Czech Republic, Turkey, they are all buying. And they are not buying paper gold. They are not buying futures contracts. They are not buying ETF shares. They are buying physical metal and taking delivery. Now here is where it gets interesting for American banks. European banks had a 3-year head start. Since 2021, they have been adjusting their balance sheets. They have been acquiring physical gold. They have been reducing unallocated positions. They have been preparing. American banks have not. American banks have been waiting for final clarity on Basel III Endgame. They have been operating under the old rules. They have been maintaining massive unallocated gold and paper gold positions because those positions were still capital efficient under American regulations. But starting Monday, the rules change. American banks will suddenly face the same capital incentives that forced European banks to shift toward physical metal. They will need to acquire physical gold to optimize their balance sheets. They will need to reduce unallocated positions that now carry higher funding requirements. And they need to do this in a market that is already tight. Let me show you the COMEX data, because this is where you can see the stress building in real time. COMEX is the primary futures exchange for gold in the United States. It is where paper gold trades, futures contracts, options, derivatives. The COMEX maintains registered gold inventory. This is gold that is available for delivery against futures contracts, gold that actually exists in vaults, gold that contract holders can claim. In August 2021, 2 months after European NSFR implementation, COMEX registered gold inventory stood at 35 million ounces. Today, COMEX registered gold inventory is 17.4 million ounces. That is a decline of over 50%. Half of the available gold has left the COMEX system in 3 years. Where did it go? It went to London. It went to Switzerland. It went to Singapore. It went to central bank vaults around the world. It went to allocated accounts where it could meet the new Basel III requirements. The paper gold market is being drained. Physical metal is being hoarded. And American banks are about to enter this tight market as aggressive buyers. Now let me talk about silver. I need to be clear about something. Silver is not gold. Silver does not receive the same Tier 1 treatment under Basel III. Silver is still classified as a commodity for banking regulatory purposes. But silver is connected to gold in ways that most investors do not understand. Silver is the most undervalued monetary metal on Earth. For 5,000 years, silver was money alongside gold. The word for money in many languages is the same as the word for silver. In French, argent means both money and silver. In Spanish, plata means both money and silver. The historical gold-to-silver ratio averaged 15 to 1, meaning it took 15 ounces of silver to buy 1 ounce of gold. This ratio was based on the relative abundance of each metal in the Earth's crust. Today, the gold-to-silver ratio is 84 to 1. Silver is trading at a massive historical discount to gold, and when gold moves, silver moves faster. In the bull market from 2008 to 2011, gold rose 170%. Silver rose 440%. Silver outperformed gold by nearly 3 to 1. When Basel III forces banks to buy physical gold, when the gold price rises, silver will follow. And because the silver market is much smaller, because annual silver production is worth only $14 billion compared to $200 billion for gold, the percentage gains in silver could be explosive. But there is something else happening with silver that the mainstream media refuses to discuss. Industrial demand is consuming available supply. Silver is not just a monetary metal. It is an industrial metal with unique properties. Silver has the highest electrical conductivity of any element. It has the highest thermal conductivity of any metal. It reflects 95% of visible light. It has antibacterial properties. Every solar panel requires silver. Every electric vehicle uses silver. Every smartphone contains silver. Every 5G antenna needs silver. The green energy transition runs on silver. In 2023, industrial demand for silver hit 654 million ounces. That was a record. Total silver mine production was 820 million ounces. That leaves 166 million ounces for investment demand, for coins and bars, for ETFs, for allocated accounts. But investment demand in 2023 was 243 million ounces. Do you see the problem? Demand exceeded supply by 77 million ounces in 2023. The deficit was covered by recycling and inventory drawdowns. But you cannot run deficits forever. Eventually, the inventory runs out. Eventually, the price must rise to balance supply and demand. The Silver Institute projects deficits to continue through 2028. 5 more years of demand exceeding supply. 5 more years of inventory drawdowns. 5 more years of tightening physical markets. And now consider what happens when Basel III sends gold prices higher. When gold breaks $2,500 per ounce, investors notice. When gold breaks $3,000, mainstream media starts covering it. When gold breaks $3,500, retail investors panic buy. And what do retail investors buy when they want precious metals exposure but cannot afford gold? Silver. Every major precious metals bull market follows the same pattern. Gold leads. Smart money accumulates. Then silver catches up violently as retail money floods in. In 1980, silver went from $6 to $50 in less than a year, an 8x return in months. In 2011, silver went from $18 to $49 in 7 months, almost a 3x return. The next silver explosion is being set up right now. Basel III is the catalyst that ignites gold. Gold ignites investor interest. Investor interest floods into silver, and silver has nowhere to go but up. Now let me talk about what the smart money is doing. Because if you want to know where markets are heading, watch what billionaires and institutions do, not what they say. In the first quarter of this year, hedge funds increased their gold holdings by 27%. Stanley Druckenmiller, one of the greatest traders in history, has significant gold exposure. Ray Dalio, founder of the world's largest hedge fund, has been advocating for gold allocation for years. Family offices, the private investment vehicles of ultra-wealthy families, have been quietly increasing precious metals allocations. A recent survey showed average gold allocation among family offices has risen to 8%, the highest level in over a decade. Central banks are buying, hedge funds are buying, family offices are buying, billionaires are buying. Who is selling? Retail investors. For 3 years, retail investors have been net sellers of gold and silver. Gold ETFs have seen outflows. Silver ETFs have seen outflows. Coin and bar demand in Western markets has been tepid. Retail investors are selling their precious metals to buy technology stocks, to buy cryptocurrency, to chase momentum. They are selling at exactly the wrong time, because the smart money is on the other side of every retail sell order. The smart money is accumulating the physical metal that retail investors are discarding. And when the Basel III-driven rally begins, when gold breaks through resistance levels, when mainstream media starts covering the precious metals bull market, retail investors will try to buy back what they sold. But the smart money will not be selling, and the price will be much, much higher. Let me address the dollar situation, because you cannot understand precious metals without understanding what is happening to the global reserve currency. The US dollar has been the world's primary reserve currency since 1944. The Bretton Woods Agreement established dollar dominance. And even after Nixon ended gold convertibility in 1971, the dollar retained its reserve status. But that dominance is eroding. In 2000, the dollar represented 71% of global foreign exchange reserves. Today, it represents 59%, a 12 percentage point decline in 2 decades. Where is that money going? Some is going to the euro, some to the yen, some to the Chinese yuan, but an increasing share is going to gold. Gold now represents 15% of global foreign exchange reserves, the highest percentage since the mid-1990s. Central banks are diversifying away from dollars and into gold. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively working to reduce dollar dependence. They are settling trade in local currencies. They are exploring alternative payment systems. They are discussing a potential BRICS currency backed by commodities. Whether a BRICS currency launches or not, the trend is clear. De-dollarization is accelerating, and gold is the neutral reserve asset that all nations trust. When Saudi Arabia agrees to sell oil in yuan instead of dollars, that is de-dollarization. When China and Russia settle trade in rubles and yuan, that is de-dollarization. When central banks buy gold instead of treasury bonds, that is de-dollarization. Every step away from the dollar is a step toward gold. Now let me talk about what happens next. Monday morning, American banks wake up to new regulatory reality. Physical allocated gold is now capital efficient. Paper gold is capital intensive. The incentive structure is flipped. Over the coming weeks, you will start seeing announcements. Banks adjusting their precious metal services, changes to allocated account offerings, modifications to gold derivative products. You will see continued strength in the gold price as banks accumulate physical metal to optimize their balance sheets. You will see COMEX registered inventories continue to decline as physical gold moves from exchanges to allocated vaults. You will see premiums on physical gold products, coins, and bars remain elevated because demand for real metal exceeds available supply. And you will see central banks continue buying, month after month, adding to reserves, preparing for whatever comes next. This is not speculation. This is not prediction. This is observation of trends that are already underway, trends that Basel III implementation will accelerate. So what should you do? Action number 1. Understand the difference between physical and paper. If you own gold or silver ETFs, understand what you actually own. Most ETFs hold unallocated gold. You own shares in a fund that owns claims on gold. You do not own gold. In a crisis, in a delivery squeeze, in a situation where physical metal is unavailable, your ETF shares may not perform like physical metal. Consider converting paper positions to physical. Take delivery. Hold metal in your possession or in an allocated vault where specific bars are assigned to you. Action number 2. Acquire physical metal before the crowd. Gold and silver are not yet in a mania phase. Retail participation is low. Mainstream media coverage is minimal. This is the accumulation phase. This is when smart money builds positions. Every major bull market starts with disinterest and ends with euphoria. We are still in disinterest. The euphoria phase is ahead. Buy physical gold and silver now, while you can acquire metal without lengthy delays, without massive premiums, without competition from panic buyers. Action number 3. Understand the timeline. This is not a get-rich-quick trade. This is a multi-year wealth preservation and growth strategy. Basel III implementation will play out over months. De-dollarization will play out over years. The full precious metals bull market may last a decade. Do not buy expecting overnight gains. Buy expecting significant gains over the next 3 to 5 years. Have patience. Hold your positions. Do not let short-term volatility shake you out. Action number 4. Diversify your forms of metal. Do not put everything in one type of product. Own some gold coins for liquidity and portability. Own some gold bars for lower premiums per ounce. Own some silver for higher percentage gain potential. Own some in your possession for immediate access. Own some in allocated storage for security. Diversification within precious metals reduces risk and increases flexibility. Action number 5. Stay informed. Watch COMEX inventory levels. Track central bank purchases. Monitor Basel III implementation announcements. Follow the gold to silver ratio. Pay attention to physical premiums over spot price. These indicators will tell you where we are in the bull market cycle. They will help you make informed decisions about when to add to positions and when the mania phase might be approaching. Let me give you the numbers. The price targets based on historical precedent and current market conditions. Gold at current levels around $2,400 is still early in this bull market. The all-time inflation-adjusted high from 1980 is over $3,200. We have not yet exceeded that level. My first target for gold is $3,000. That represents a breakout to new nominal highs and psychological round number resistance. My second target is $3,500. That level represents a matching of the 1980 inflation-adjusted high. My third target is $5,000. That level may sound extreme, but consider the money creation since 1980. Consider the debt accumulation. Consider the de-dollarization trend. $5,000 gold is not unreasonable in a world where the U.S. national debt exceeds $35 trillion. For silver, the math is even more compelling. Silver at current levels around $28 is deeply undervalued relative to gold. The gold-to-silver ratio at 84-1 is near historic extremes. If the ratio normalizes to 60-1 and gold reaches $3,000, silver would be $50. If the ratio normalizes to 40-1 and gold reaches $3,500, silver would be $87. If the ratio normalizes to 30-1 and gold reaches $5,000, silver would be $166. These are not fantasy numbers. These are mathematical calculations based on historical ratio normalization and gold price targets. Silver at $50 is less than double from current levels. Silver at $87 is roughly a triple. Silver at $166 is a 6x return. That is the upside potential in silver over the next 3 to 5 years. Ladies and gentlemen, we are at an inflection point. The Basel III Endgame rules take effect Monday. American banks join European banks under a regulatory framework that favors physical gold. The incentive structure for the global banking system has permanently shifted. Central banks are accumulating gold at a record pace. De-dollarization is accelerating. Physical supply is tight. Paper markets are stressed. This is not a temporary condition. This is a structural change in the global monetary system, a change that has been building for 15 years since the 2008 financial crisis, a change that Basel III codifies into regulatory permanence. Gold is returning to its historical role as the foundation of the monetary system, not through a dramatic announcement, not through a return to a gold standard, but through a quiet regulatory reclassification that makes gold the preferred reserve asset for banks and central banks worldwide. The window to accumulate physical precious metals at reasonable prices is closing, not slamming shut, closing slowly, like a door being gradually pushed by a steady wind. Every month, more physical metal moves from weak hands to strong hands. Every month, central banks add to reserves. Every month, the available supply for new investors decreases. Monday marks the next phase of this transition. American banks entering the physical gold accumulation process, joining Europeans who have been building positions for 3 years. The price may not move Monday. It may not move next week. But over the coming months, as banks adjust their balance sheets, as physical demand exceeds available supply, as the reality of Basel III works through the system, prices will move. And when prices move, they will move quickly. Gold does not rise in straight lines. It consolidates, frustrates, shakes out weak holders, then explodes higher. Silver does the same but more violently. If you are waiting for confirmation, you will buy after the move starts. If you are positioned now, you will benefit from the move as it unfolds. The choice is yours. But understand this. The regulatory framework has changed. The incentives have flipped. The central banks are buying. The smart money is accumulating. What the mainstream financial media is not telling you, what CNBC and Bloomberg and the Wall Street Journal are not covering, is that the global monetary system is quietly restructuring around gold. Basel III is the mechanism. De-dollarization is the trend. Physical accumulation is the strategy. And Monday morning, the next phase begins. You have been warned. You have been informed. You have the information that 99% of investors do not have. What you do with that information is up to you. But do not say you were not told. Do not say you did not know. Do not say you did not have the chance to prepare. Because when gold is $3,000, when silver is $50, when the mainstream media is finally covering the precious metals bull market, the opportunity to buy at current levels will be gone. The countdown is over. Basel III Endgame is here. Monday morning, the new rules take effect. Position yourself accordingly.